Okay, so today we'll be talking about volatility 101s. So I'll be doing a breakdown from a monthly time frame to the maybe to the least lower time frame. Now this is a monthly time frame and we start our breakdown. Now let me say this. One thing we should know is that market trade from liquidity to liquidity, in which we already know that liquidity is the originator of price movement. So we'll be focusing from liquidity to liquidity. So this is our 101s. Our first attention should be on the first on the low, on the recent low, no, sorry, the recent high and the recent low, the recent high and the recent low. So after having the recent high and the recent low, after having the recent high and the recent low, this is our recent low. Now remember what I said. I said that market trade from liquidity to liquidity. Now if you pay attention here, we have we have our internal range liquidity here and we have our external range liquidity here. The external range are simply the previous low and the previous high, while the internal range can be inverse fair value gap, order block, or breaker block. So having that one at the back of our mind, so we are marking this, and this is the reason. The reason is because when the market mitigates the internal range liquidity, definitely it's coming from the external range. So if the market is coming from the external range, definitely is going to go to the internal range. So having this at the back of our mind, we'll move directly to the weekly time frame. So what do we have on our weekly time frame? We also have we will also pay our attention to this recent low, and we have this no this recent high rather. I have this recent low. So our recent high, our recent low. Remember what I said, market trade from liquidity to liquidity, the internal into the external. So if the market is coming from the external if the market is coming from the external internal range, definitely it's heading towards the external range in liquidity. So let me mark it down. So let me mark it down. So having said this, then we move to our daily time frame. Now on our daily time frame, we focus on the recent highs and the low. So this is our recent high. This is our recent high. Coming, let me narrow it down properly. So this is our recent high. These are this is our recent high. This is our recent low. So the recent high, the recent low. Okay, now having this, we said that market trade from liquidity to liquidity, and we said that it starts either from the internal into the external or the external to the internal. Okay, after having that, we had a break of market structure here. We have a break of market structure here. We had a break of market structure here. Now it doesn't stop there. It doesn't stop there. There are many things that we have to pay attention to. Now there's a reason why the market, on a good day, we should be expecting the market to move to this area. On a good day, at least we should be expecting the market to come to the order block. But when we pay attention to it very well, we find out that there's a reason why the market is not going to head towards this order block. Now, what is the reason? Very, very simple. This is the reason. We had this fair value gap. We had this fair value gap. We have this fair value gap. We had the second fair value gap. No, no, just the fair value gap. This is it. The first candle, the second gap, you can see it very, very long, and there's a space within. The market is here to tap into that particular zone. Then after all of the market started rallying down to this particular zone, and the market broke into the fair value gap. And normally we should expect the market to just tap into the fair value gap and started going to the upside, but unfortunately we don't have it that way. The fair value gap was violated, which turned into an inverse fair value gap. So now what is an inverse fair value gap? An inverse fair value gap is a kind of fair value gap that failed, and when this fair value gap failed, it tends to take the opposite direction of that original fair value gap. So having this, we had a break of structure. let me go to 4 hours time frame like that. So we had a let me so to keep it very very clean a bit. So we had we had the buy side liquidity being raided. We had the buy side liquidity being raided. So when I saw this, I knew that the market is definitely coming for the sell side liquidity. So if the market is coming down for the sell side liquidity, now there are pointers, there are reasons why we must take the sell. Now on our 4 hours time frame, I saw this. I saw this on the 4 hours time frame, which is the buy side liquidity being raided again. Then we had a break of structure here. We had a break of structure. The market retraced back for the first sell entry. But considering considering the kind of model I will use, I prefer that I have a fair value gap on the 4 hours time frame, in which the market decided to print it on the 4 hours time frame. And when the market created this fair value gap, so when the market created this fair value gap, I knew that there's something to expect, which means that the market is going to come back and tap into that fair value gap. It is normal thing. The market will surely do it. So whenever, remember what I said initially, I said that market trends from liquidity to liquidity, internal to external, taking the buy side first, coming for the sell side liquidity. Now this is a 4 hours time frame. There are many things that I can actually do. Now the first thing is that I look for the recent high and the low. This is my recent high and this is my recent low. Let's mark it. My recent high, my recent high. So I had my recent high here, I had my recent low here. So I had my recent high, my recent low. I remember what I said. I said that market trade from liquidity to liquidity. So this is a fair value gap, which is an internal range liquidity. So we expect the market to tap into this fair value gap, then start coming for the external liquidity. And one thing about it is that it is following an alignment with it's actually following an alignment with the previous time frame, which means that we are very very bearish on volatility 100 1s. So if we are very very bearish on volatility 100 1s, definitely we are selling down. Now let's go to, this is a 4 hours time frame, let's go to 30 minutes time frame to check that particular zone. So when we checked it, I saw the fair value gap here. So normally the market is going to raid the liquidity. The market raided the buy side liquidity again. Then let's go to 15 minutes time frame. Now you can just place your sell entry here, then your stop loss somewhere above this high, and expect the market to come to the downside. So one thing you should know is that go to your monthly time frame first. In your monthly time frame, mark out the recent highs and the recent low, the recent high, the recent low. Look for the liquidity, look for the possible liquidity, maybe it is the internal range or the external range. And look, yeah, in this position we can easily say that the market mitigated the internal range first, then coming for the external range liquidity. Then we had a weekly time frame. There was there was something that was very very spectacular here. We can accurately see repetitions of pattern, which means that the fractal nature of price is that anything that happened in the previous higher time frame, you will see the market replicating it again and again. So now we can see it very very well that it was almost the same thing with what happened on the monthly time frame. Now the same thing are applicable here on our weekly time frame. So when we go to our daily time frame, we actually saw the same thing here. So this particular volatility 100 awareness is going to sell for a long while. It's going to sell for a long while. So expect volatility 100 awareness to get to this particular zone from a monthly time frame perspective. So it's going to be a long journey from here to this particular zone. So if you have any question, you can just put it under the comment section and I will respond to it. Thank you.